Let's be honest, no little girl tells her mom when she grows up she wants to become an accountant just because it all seems so boring. It's numbers, it's black and white, it's balancing reporting, but it doesn't have to be boring. I fell in love with accounting once I started doing all of this. So if you want to enter the intimidating world of finance, let's break it down, let's make it simple, and while we're at, let's make it a little bit pink. So if you are going to be doing something, you should probably know why you're doing it. Why accounting? Because it is a system that is going to record every transaction that happens to a business. You're going to identify, record, and communicate all activities that happen within that business, and it is a highly valuable and profitable skill. What it all comes down to is that accounting is the language of business. The accounting records are going to show everything you need to know about that company and its performance. Accounting information will be directed towards internal and external users. External users are people who do not directly manage the company, therefore, they have limited access to the company's accounting information. You can go online and you can search up a company's balance sheet or their income statement, but you're not going to see more private things like their inventory invoices because you do not directly manage the company. Non-executive employees, suppliers, lenders, shareholders, voters, and regulators are also going to be external users who can access the public accounting information about a company to help them come to a decision. So, on the other hand, we have internal users. Internal users are people who directly manage the company, therefore, have access to the accounting information at full. As a customer, I won't know the specifics of a makeup company's accounting information. However, the purchasing manager who has to buy the lip gloss, he's going to know all of the accounting information because he needs to know this for when and how much product he has to buy. Accounting is going to follow a set of rules known as GAAP, and no, it is not the same as the store. Generally accepted accounting principles means that accounting information should be transparent and honest, but also relevant. There are four general principles. Your measurement principle, also known as your cost principle, means that everything has to be accounted for based off its actual cost. Let's say I sold a dress for $400. I need to account that I sold that dress for $400 and not $750 just because I believe that it's valued at $750. It sounds kind of ridiculous that I even acknowledge that, but it's important that we understand these principles right off the bat before we get into the actual process of accounting. Next, the revenue recognition principle says that revenue will be recognized when a product or service has been provided, and the amount the customer will pay is going to also be recorded at the same time. If it's Black Friday and I sold a skirt for half off, I'm going to record that I sold that skirt half off on Black Friday. Your revenue recognition is also going to be matched by your expense recognition principle, and I say match because it's also known as the matching principle. If I sell something, I have to account for what it cost me to sell that. So when I record a revenue, I also have to record the expense I incurred to make that sale. The last major principle you need to know is the full disclosure principle. It's pretty self explanatory, meaning that the company just needs to disclose information that can help an external or internal user understand the financial statements. And by the way, accounting is a lot less vocab and a lot more knowing what you're actually doing. So after this video, it's going to become a lot more hands-on with trying to figure out how to account. So if you want to learn how to actually account, make sure you subscribe and follow for follow-up videos where we will get right into that. Anyway, our assumptions start off with the going concern assumption. This means that we assume a business is going to continue operating rather than being shut down or closed. Accounting records money essentially. So your units are going to be in money. That is your monetary unit assumption. The time period assumption is going to be important for a company to figure out their accounting period, but essentially it just means that you're dividing up the company's life, whether that be yearly, semi annually, quarterly, or monthly. And lastly, the business entity assumption assumes that a business will be accounted for separate from its owner and separate from other companies. When we mention that GAAP says accounting information has to be relevant, it plays into what is known as the cost constraint. When a business is putting out accounting information, it should have more benefits than it does costs that it took to put out that information. So if a business exhausts 100 grand in 72 hours, but that information is not met with the same value or more, then a company does not need to put it out. The cost benefit principle says that a company should only execute on an action when the benefits outweigh the cost. They're both very similar, but essentially it just means that when your benefits are more than your costs, then you should go for it. If not, don't bother. Now, what I say next is probably the most important thing you need to get out of this video. You're going to need to commit this to memory because every transaction and financial activity that impacts a business will be applied to this equation. Now, let's break down what this means. Assets are what you own, liabilities are what you owe, and equity is what the owner keeps. That's the invested money and retained earnings. Together, your equity and your liabilities will always equal total assets, and when everything is balanced, you know you did something right. By the way, when I say balance, I mean you have $10,000 here and you have $10,000 here. If your equation is ever not balanced, you need to go back and you need to find that mistake and fix it because problems in accounting do not go away. They will only get worse and they are going to haunt you and they will affect your business negatively. All right, now that we got that down, we're going to expand our equation. There are four main parts that go into your equity. Common stock is the money the owner puts into the business. It's the invested money. So let's say I'm opening a boutique and I need to put $250,000 in to get started. $250,000 is my common stock. And increase the common stock is going to increase my equity. Dividends are payouts to shareholders essentially as a thank you for holding that company's stock. Dividends are optional and a company does not have to pay them. However, it's a nice way to reward shareholders for staying loyal. An increase to dividends is going to decrease my equity because I am taking out money to pay my shareholders. All businesses are in for a profit and they are going to sell you something. That money that comes into the business from whatever they sold is the company's revenue and is going to increase their equity. But when you sell something, you need to account for what it costs you to sell that. Let's go back to my boutique. Let's say I made $400 on selling a dress. Yay, I made $400 in revenue. However, I also spent $250 to buy the fabric to make that dress. So that is going to be my expense and that is going to decrease my equity. External transactions are going to be activities that happen between two entities or more and they are going to affect the company's accounting equation. Me selling a dress to a customer is going to be an external transaction. An internal transaction will be any activity happening within the business. So me buying and using up fabric is going to be an internal transaction and I'm going to log that as a supply expense. We were talking about what accounting information users use to make informed decisions and to understand a company's finances. These come from the financial statements like the balance sheet, the income statement, statement of retained earnings, and statement of cash flow. The income statement is going to reflect the company's net income or net loss after you subtract your expenses from your revenue. This statement will help users recognize if a company is working on a net profit or a net loss, hopefully the former. This statement reflects all revenues and expenses of an accounting period, whether that be yearly, quarterly, monthly, semi-annually, you name it. It's going to reflect over a span of time. The balance sheet is going to show the balance of your accounting equation at a specific point in time. I mean that it's going to say like as of January 1st. It's going to be on a certain day. You're going to have your assets on the left side and your liabilities and your equity on the right side. You're going to have the same number here and the same number here if you did it right. The statement of cash flows is pretty self-explanatory. It's just going to show the cash that comes in and the cash that goes out of business. The statement of retained earnings is going to take your net income or net loss, but let's hope not, and it's going to subtract dividends from it. That way you get your net retained earnings. Remember, dividends decrease my equity because it's money I'm paying out to a shareholder. So once I subtract my dividends from my net income, I'm left with the retained earnings and that is what the owner keeps. Those are the primary financial statements and it's going to reflect the business's performance and it's going to help users understand where the business is at financially speaking. Personally, I'm not a big math lover, so I was surprised when I fell in love with accounting because of all the numbers, but the math that goes on is actually really simple. Take your return on assets, for example. You are going to divide your net income by your average total assets, and your average total assets come from the beginning assets and the ending assets of that same period. To get the average, you are going to add them together and you're going to divide by 2. This is going to show how effectively a company is using its assets to make a profit. Let's break it down to something that's a bit more simple. Let's say, for example, that my beginning assets were $100,000 worth, and by the end of that same accounting period, they were $90,000 worth. My net income for that accounting period was $60,000. I'm going to add my beginning and my ending assets to get 190,000 and divide by 2 to get 95,000 for my average total assets. I then am going to divide 60,000, my net income, by my average total assets. My return on assets was 63%. Is that terribly accurate? It depends on how good of a designer I am, but you get the point. The most important thing for you to get from this video is the accounting equation. Know this and know that everything that happens to a business will be reflected in this equation and must be balanced, and everything else is going to fall into place. I just threw a lot of definitions at you, so go down below to check out my free downloadable study guide with all the terms and definitions that we went over in this video. And then if you want to get some practice in, try out my free downloadable worksheet on the accounting equation. And of course, don't forget to subscribe for more videos and free downloadable worksheets on each new mini lesson about accounting. You're gonna ace it, you're gonna get it, and accounting is gonna be for you.